In the last episode, we set out our first revenue stream, the basic subscription, and connected it to users from growth section. We now have a revenue forecast. But revenue on its own isn't the full picture. To understand how profitable each sale actually is, we need to introduce cost of sales, the direct cost that comes with delivering the subscription. From the sales section, you will notice two tabs at the top right: sales and cost of sales. We are switching to cost of sales now, but you can always add cost of sales in the revenue form below conversion panel. This dashboard shows you four key metrics: total revenue, total COGS, gross profit, and gross margin, all linked directly to the revenue streams you've set up. Right now, they are all at 0 or blank because we haven't added any cost yet. Below that, you have two charts: COGS by category, which breaks down your cost by type, and COGS by revenue, which shows how costs map to each individual revenue stream. This will populate as soon as we add our first cost. Click Add New Cost button at the top of the page. A menu appears with four pre-built categories: infrastructure and cloud, third-party software licenses, customer support, and professional services. These cover the most common direct cost types for a digital or SaaS business, but for other types of businesses you will see other most common direct costs. For our basic subscription, the most direct and honest cost to model is cloud infrastructure, the hosting that scales with each paying user. So we expand infrastructure and cloud, and you can see three options: cloud service, database hosting, and backup storage. Let's select cloud service. You are now on the Add Cost of Sales page. Let's walk through each field. First, the category is already set to infrastructure and cloud, and let's name it Microsoft Azure, for example. Clear and specific. Next, the cost type. This is one of the most important decisions on this page because it determines how the model calculates this cost over time. Your options are per sign-up, per user, per new paying user. We've chosen per paying customer, meaning each month for every active subscriber, the model will add this cost. On the right, you will see a revenue allocation question. Which revenue stream should this cost be assigned to? We tick basic subscription. This is what connects the cost direct to the revenue it supports, allowing the model to calculate gross margin per stream, not just in aggregate. Now we set the per paying customer cost. We've entered £3 per customer per month. On a £23 subscription, that's roughly 13% of revenue going to infrastructure. A realistic figure for an early stage SaaS product running on a managed cloud platform. Below that, there is an annual cost increase plan. This lets you model inflation or expected price changes in your infrastructure cost over time. The options are no cost increase, a fixed amount per year, or percentage per year. For simplicity, we've selected no cost increase. You can always revisit this once the rest of the model is in place. You will also notice options like exclude and include VAT and volume-based cost scaling toggle, which would let you model economies of scale as subscriber number grows. We're leaving those off for now to keep the baseline clean. When everything looks right, click Add Cloud Service Cost. The model processes instantly and you are taken back to the cost of sales dashboard. It's no longer blank. You can now see the revenue for the next 12 months driven by the basic subscription we set up before, the COGS, the cloud service cost calculated month by month based on paying customer numbers, gross profit, revenue minus COGS, and gross margin, in this example around 87%. The COGS by category chart shows infrastructure and cloud as the only category so far. The COGS by revenue chart maps the cloud service cost directly against the basic subscription. So you can see at a glance which revenue stream is carrying which cost. Before we close this episode, let's go back to the main dashboard, because this is where everything comes together. At the top, you will notice the monthly burn rate has already updated. It's now slightly lower than before, because the revenue and COGS we've set up are flowing into the overall financial model automatically. Nothing needs to be manually connected. Scroll down to the forecast table. By default, it shows revenue, net burn rate, and end balance. And you can already see revenue appearing month by month, starting from September 2026, as our first subscriptions come in and growing steadily through the year. But revenue on its own only tells part of the story. In the top right of the forecast table, you will see Customize Metrics button. Click it. A panel opens with a list of additional metrics you can add to the table. Cost of revenue, gross profit, operational expenditure, capital expenditure, and more. These are all derived directly from the inputs you've made across the model, so no extra work needed. Let's switch on cost of revenue and gross profit. The table immediately updates. Now you can see 3 new rows sitting between revenue and net burn rate. Cost of revenue, the cloud service cost flowing through from our COGS setup, calculated per paying customer each month. It started 3 in the first month with subscribers and grows in line with the subscriber base. Gross profit, which is revenue minus cost of revenue in September, that's £20, by April is 120. A clean month by month view of what the business is actually earning after direct costs. This is the value of having everything in one connected model. You make a change in sales or cost of sales, and it immediately flows through to this dashboard, to the forecast table, and to the gross margin figures, without touching a spreadsheet. You can customize this view at any point, add what's useful for your current stage, and remove what isn't, as you build out more of the model. Operating expenses, salaries, capex, those metrics will appear here too. So to wrap up this episode, we've now completed the full gross profit picture for our basic subscription stream. We added the cloud service cost of sales, tied it to the basic subscription and £3 per paying customer per month, and watched the model instantly calculate gross profit around 87% margin. And on the main dashboard, we can see all of that reflected in the forecast table. Revenue, cost of revenue, and gross profit, month by month for the next 12 months, and across 5 years. In the next episode, we will move on to analyzing the profitability of your revenue.